Most people think that when a currency is weak, it means the country behind it is weak too. That's the story we've all been told, especially in the West. Strong nations have strong currencies. Weak nations have worthless money. It sounds simple, almost obvious, but what if that idea is completely wrong? What if a weak currency isn't a failure, but a deliberate strategy? Because that's exactly what China did. For decades, it kept its currency, the yuan, artificially low, not because the economy was collapsing, but because it wanted leverage. And that one decision ended up reshaping the global economy. Now, before we go deeper, if you like this kind of content where we break down money, power, and the systems behind them, make sure you like the video and subscribe, because this story isn't just history, it's a pattern. To understand how, you have to go back to the late 1970s. China had just come out of the Cultural Revolution. The country was closed off, people were poor, and industries were outdated. Then Deng Xiaoping came in and changed everything. In 1978, he launched reforms that opened China to global trade. Factories started appearing in coastal cities, foreign investors were invited in, and the goal was clear: industrialize as fast as possible. But there was a problem. How do you compete with developed economies when you're starting far behind them? China's answer was simple: make everything cheaper. And the fastest way to do that was through the currency. Normally, if a country exports a lot, its currency gets stronger. Let's say the yuan should naturally be around 5 per dollar. With strong exports, it might rise to 4. That would make Chinese goods more expensive abroad. But China didn't want that, so instead, it intervened. Its central bank kept the yuan much weaker, sometimes around 8 per dollar. How? By constantly buying dollars and selling yuan. Every time dollars flowed into China from exports, the central bank absorbed them and added them to its reserves. By 2014, those reserves had reached nearly $4 trillion. The result was simple. The yuan stayed cheap, and Chinese goods stayed incredibly cheap. Think of it like a company that could sell a product for $50, but chooses to sell it for $10 instead. In the short term, it gives up profit, but in the long term, it wipes out competitors and dominates the market. That's exactly what China did with its currency. It undersold itself to gain control, and it worked. Through the 80s, 90s, and early 2000s, China's factories exploded, exports soared. Western consumers loved the low prices. Stores filled up with cheap products, and it felt like everyone was winning. But that wasn't really the case, because while the West enjoyed cheap goods, China was gaining something much bigger. The dollars it earned didn't just sit there. It recycled them back into the system by buying US Treasury bonds. So, on one side, Americans were buying cheap products from China. On the other side, they were borrowing money from China to keep spending. It created a loop, and China was quietly strengthening its position inside that loop. This is where the biggest misunderstanding happened. In the West, a strong currency is seen as power. But China didn't care about looking strong. It cared about becoming strong. By keeping the yuan weak, it bought time. Time to build factories, infrastructure, supply chains. Time to lift hundreds of millions of people out of poverty. While others focused on short-term benefits, China was playing a long game. And by the time the world started realizing what was happening, China had already become essential. From electronics to textiles, from steel to consumer goods, it wasn't just part of the system anymore. It had become the backbone of it. Of course, this strategy had consequences. In the United States, politicians began accusing China of currency manipulation, and they weren't wrong. China was actively intervening, but calling it manipulation makes it sound like cheating. In reality, it was strategy. Cold, calculated strategy. A cheap currency meant American consumers got cheap products, but it also meant American factories shut down. Jobs moved overseas. Entire regions lost their industrial base. In the short term, people enjoyed lower prices. In the long term, the structure of the economy shifted, and the irony got even deeper. Every dollar spent on Chinese goods gave China more power to buy US debt. So the system fed itself. Consumption on one side, control building on the other. Eventually, China didn't need to keep the yuan that weak anymore. By the mid-2000s, it started letting the currency rise slowly, not because it changed its philosophy, but because the job was already done. The factories were built, the infrastructure was in place, and the supply chains were under control. The weak currency had been a tool, a ladder, and once China climbed it, it didn't need it anymore. But the strategy didn't disappear. It evolved. Instead of just using currency, China started applying the same logic to entire industries. Subsidize heavily, sell cheap, flood the market, push competitors out, and take control. Steel, solar panels, electric vehicles, different sectors, same logic. Short-term sacrifice, long-term dominance. Today, the yuan is more flexible, and China is pushing it into global trade, even trying to challenge the dominance of the dollar. But the mindset hasn't changed, and here's the real takeaway. A weak currency doesn't always mean weakness. Sometimes it means strategy. Sometimes it means control. History shows this again and again. Different empires, different tools, same game. Money is never neutral. It's always a tool of power. If this gave you a new perspective, like the video and subscribe.